Most investors think gold can't generate income, but one ETF proved them wrong. While markets struggled, David Miller's GOLY ETF quietly delivered over 23. As we move deeper into 2026, one investment story from the past year continues to stand out. David Miller's GOLY ETF, which delivered around 23% returns during the gold price surge. In a time marked by inflation concerns, market volatility, and global uncertainty, gold made a powerful comeback. And GOLY was positioned perfectly to benefit. Today, we'll break down how the GOLY ETF works, why it performed so well, and what investors should understand before considering it. What is the GOLY ETF? The strategy shares. Gold Enhanced Yield ETF, ticker GOLY, is not a traditional gold ETF. Instead of simply tracking gold bullion, GOLY uses a dual strategy approach: gold price exposure through derivatives, income generation through investment-grade bonds. This allows investors to benefit from gold's upside while still receiving regular income, something physical gold can't provide. By 2026, this hybrid structure has made GOLY especially appealing to investors looking for inflation protection without sacrificing yield. Who is David Miller? David Miller is the portfolio manager behind GOLY and has gained recognition for navigating volatile markets with a risk-managed, income-focused approach. During the gold rally that unfolded through 2024 and 2025, Miller's positioning allowed GOLY to outperform many traditional gold ETFs, earning industry attention and strong investor inflows heading into 2026. How GOLY's strategy actually works. Here's the simple breakdown. Bond layer. The majority of GOLY's assets sit in high-quality bonds, which generate steady income. This income supports monthly distributions to investors. Gold layer. Instead of holding physical gold, GOLY gains exposure using gold futures and contracts, allowing it to capture gold's price movements efficiently. This structure helped GOLY remain resilient even when interest rates and equity markets were unstable. Why gold's surge still matters. In 2026, gold's surge didn't happen overnight. It was driven by persistent inflation pressure, central banks increasing gold reserves, currency debasement concerns, geopolitical instability. Even as markets entered 2026, gold continued to hold elevated levels, reinforcing its role as a store of value and keeping gold-linked ETFs like GOLY relevant. GOLY performance breakdown. During the height of the gold rally, GOLY delivered roughly 23% returns, outperforming many traditional bond funds, equity indices during volatile periods, passive gold ETFs with no yield. The ability to compound income while capturing gold's upside is what separated GOLY from the pack. Pros and cons of the GOLY ETF. Pros: exposure to gold without holding bullion, monthly income stream, inflation and volatility, hedge diversification beyond stocks. Cons: more complex than standard ETFs, uses derivatives, higher expense ratio than passive funds. Performance depends on both gold and bond markets. Final thoughts for 2026 investors. As we move through 2026, GOLY stands as an example of how alternative ETF strategies can thrive during uncertain times. While it's not for everyone, investors seeking gold exposure with income may find GOLY worth researching further. As always, past performance doesn't guarantee future results, and doing your own due diligence is essential.